Now we're going to get into what's happening in the US. And before we get started, it's important to talk about, well, what did the Fed just do? There wasn't any real surprise. If anything, I would say it was a slightly hawkish tint. And the reason why is, and this is where it gets funny, everyone nitpicks on, well, what did they say? What exact words did they use? So this is where we're going to nitpick in terms of what were the worded, how is it worded, what does it mean? So our expectations coming in was rate hike in March, accelerated quantitative tightening. That was our view, was that was going to be the key piece to it. So how did we do? Well, the state of the economy, obviously they talked about COVID and how it didn't, it's impacting, but it's not the same as previously. So there isn't too much of a change that we expect. Now, on the quantitative easing side, it will end in March. So we were thinking it was going to be accelerated a bit, but instead it's going to end in March. So we're going to see that happen. So that I would file that under a bit more of the dovish side. What they're saying right now is it's going to initially be brunted. The MBS or mortgage-backed securities is going to bear the largest piece of that. So that is when we start looking at mortgage rates and pricing of homes, that could become a little bit of a bigger issue, especially as MBS comes back. Now, on the forward-looking language is where you can kind of skew this a bit more on the hawkish side. And this is, when you look at the fact that there was no mention of being gradual. So the gradualism or rate staying below the long-run level has been removed. So we expect to see that rate hike in March. We've been saying from the beginning it's going to be 25 basis points. It should be 50, but they're only going to do 25. But it also doesn't say anything about how gradual it'll be. Our view was that we're going to have 3 rate hikes in a quick succession. And by taking away the gradual terminology, you could skew that different ways. I would say that just means that they're not going to go 25, 50, 75, they're just going to go 25, 25, 25. Some might say, well, it just means that they're going to do them back to back. So I just think that, it still kind of plays into our base case of 3 kind of rapid increases of 25 basis points, then kind of pause after 3, let the market kind of digest it. Everybody's already priced in an increase in March. So again, what they're saying here is, I think mostly priced in. There's some adjustment on what does gradual, without saying gradual, without rates staying below the long run level. Maybe that means that we could actually see it go above 2%. Again, crazy, I know, but just to put into context, we're going from 25 basis points to 50 basis points. And the market is acting like we're going from 25 basis points to 5%. So just to put it into context, but again, these are just things that are important when we look at activity. Now, when we look at what happened during the beginning of the week, the end of last week, when we saw some very not healthy volatility, you can see what came through, where the turnover in trade was. So when you look at the SPY, it traded over $100 billion worth of shares for only the second time ever, with obviously March 2nd being was another time. Which is more, but it's more than four stocks combined. The Qs smashed its record with 66 billion, which was set on Friday. If you combine the two on Friday and Monday, they did 170 billion, which is an all-time record, to give you an idea of some of the different things that have been happening and the fears that are out there. So when you look at some of that buying the dip, when you look at the business cycle, it's the most important driver of stocks over the medium-term horizons. And when you look at the ISM Manufacturing PMI, which we're going to go through in a bit more detail, going to show just where things are and how you're going to continue to see, I think, some of these headwinds as ISM PMIs get a bit weaker, and that's going to draw down some of the S&P forward EPS. Now that we have, we're past the Fed rate decision, how the market kind of prices that in. Now that we've had a lot of this back and forth, a lot of volatility, how much does that continue on? Now, when we look at cumulative retail order imbalance, you can see that at different periods of time on January 24th, you can see that they were one of the largest sellers, and I think that's when we started to see a lot of this fear. We came in, we had a very ugly open, then we had some of the rally back. Then on yesterday, so today's Wednesday, on Tuesday, we came in fairly low. We had a rally, and then Microsoft reported. That brought the market down. Then they issued guidance, and now we were back up. So there's been a lot of volatility for not a whole lot of movement. But when we look at the retail side, monthly net purchases of U.S. equities by individual investors still remains robust. Individual traders in 2021 purchased a net $292 billion of U.S. stocks in exchange-traded funds. This is more than 7 times the amount in 2019. Individual investors so far appeared poised to continue similar levels of buying activity in 2022. So again, that's also led to some of this unknown, because when you look at the peak prior to COVID, so if you look at peak Qs versus where we are today, I mean, the Qs are about 100 points from the high of March 2020. So any type of adjustment or any type of correction, could increase some pressure, could create margin calls, which is why we look so much at what is happening. Now, when you consider the dual mandate of the Fed, and not to say that the Fed cares about their dual mandate, as they've shown a propensity of caring what the stock market does, but there's 2 pieces to it. You have long inflation, inflation maintaining that or at around 2%, as they call it, and full employment. So we are now approaching, if not already at, full employment, while we are sitting here and we are also at an inflation rate that continues to accelerate. So the question becomes, when do they raise rates? And as we talked about already, under that mandate, they should already be raising rates, which is why the removal of the gradual term becomes so significant, even though realistically, how significant is it? But when you look at essential spending and non-essential spending, this is what I think creates some of that fear and gives us some of the views on where inflation is going. That essential spending still continues to grind higher. So U.S. household spending on essential items rose to a record in the December 21's survey. From inflation hitting household spending power and expectations as likelihood of making big purchases over the next 4 months declined. So you're continuing to see this pressure. And the essential spending, that stickiness, is where we see a lot of that fear and the unknown. Now, cost pressure passed on in most sectors. So it's one of the positives, which I think is going to change throughout 2022, is the ease for most companies passing on price increases or cost pressures being passed on. About 2/3 of sector analysts say the companies they cover can easily or somewhat easily pass on their cost increases to end customers. I disagree with that. I think that was a very, and I should preface this, because when you look at the chart, it's from November 1st and November 14th. So I agree that was the case in 2021. I do not think that is the case in 2022. And you're already starting to see that, which I think is some of the fear here. So let's just put this into perspective. So I was asked to give a quote in the UK about Unilever and some of the pressure that continues to ramp up on Unilever, talking about finding ways to cut costs, manage their supply chain, because they are seeing a significant amount of costs that are coming through, and they're now struggling to pass that on. Take that into the U.S. Consumer products, Kimberly-Clark sees a tough year with higher key input costs, continuing disruptions and uncertainty around the pandemic, and it's going to hike prices for its consumers too as it tries to protect already crimped margins. Consumer staple stocks are underperforming, led by a slump in Clorox and Kimberly-Clark as well. So these are the pressure points where we saw, I agree, 2021, you were there, you could pass this on. 2022 is going to be a very different story. And I think that is some of the pressure that comes into 2022 when you're looking at what the economy is doing, where some of that pressure remains. And why is that so important? Well, let's look at consumer price index breakdowns. I think this is a really good chart looking at shelters, obviously a huge component of it. Food, which as we talked about in segment 1, continues to be an underlying problem. And then you look at energy, medical services, all of these pieces, you're seeing a lot of this pressure and some of these problems in terms of what can be passed on a pricing point. So when we look at how the Fed is going to respond, the expectations of a over 25 basis point hike in March, a 25 basis point price is already there. It's been priced in. And then as you get higher, the expectation of a 50 basis point price comes in. I think at this point we will most likely see and sit at a 25 basis point. But one of the things that they're going to want to try to get under control is not only the VIX, but also the MOVE index, because bonds are becoming more and more volatile again. And if you look back to where we were in February of last year, when you look at the MOVE index, which is that white line, you can see that the volatility in the bond sector is going higher again. And that is some pressure that they're going to want to try to manage. So that's why I think in a kind of a slow, steady decline of QE is there. But now you have the increase in interest rates trying to essentially slow down what is happening in the market, how some of this is adjusting, and what's going to happen going forward. But the MOVE index, I think, is going to be the one to watch in the near term. So realized volatility over the rolling 3 months. It's just, this is the MOVE index essentially broken down. You can see that the volatility continues to increase and putting a lot of pressure on bonds, which is something that I think the Fed is really going to want to manage, which is why we will see some of these rate increases and trying to manage it. Now, financial conditions index has deteriorated a bit. When you look at just where things are, this is also something that they're going to try to manage amongst inflation pressure points. These are a lot of the unknowns that we've been discussing. Now, when you look at that, when you look at the steepener, so one of the views is looking at the five-year forward Treasury yield. The view is that you're going to get some of the steepening or the bear steepener, where the long end continues to go up, front end comes down. Realistically, I think we do get a flattener. Maybe a quick inversion, and then you get the steepener. But this is just looking at where rates are. Growth isn't a huge issue right now, as we've been saying. Don't get me wrong, we are concerned about growth, but in relative terms, because we do think growth will be a problem, but we're still going to grow, just not at the rate it's expected. So typically, you get bond yields coming down when there's a concern about growth. I think the bigger concern right now is going to be where that inflation is and how quickly can they try to get in front of it. And this is looking at the Fed is on reducing its balance sheet. Here's kind of that spread on the projections. I think what they announced fits pretty closely into what they're talking about of a fairly gradual reduction in capacity. And now when you look at the long-term budget outlook, things get a bit scary when you're looking at the U.S., which is something that they're going to want to try to bring under control when you're looking at federal debt and how we are on that treadmill of not only trying to get, right now we're borrowing about 50% or over 50% of the budget, and you can't keep doing that because not only do you have to then continue to borrow to maintain your budget, but then you have to roll what you've already borrowed, and you can see how this compounds on itself. Which is where you start looking at U.S. growth moderating. Again, this is everything that we've been talking about, those leading indicators on new orders, where those new orders are, how that's coming through, and how that's going to pull the PMI down, and those new orders minus inventories, and really what the PMI is going to see that pressure point. OECD leading indicators, it continues to move negative, which again is going to put that pressure on ISM Manufacturing, which is what we've been talking about and we're already seeing, which we're going to talk about in the it coming up right here. So when we look at the flash ISM, the Markit PMI, manufacturing came in at 55 versus the estimate of 56.7. Services came in at 50.9 versus the estimate of 54.8. Composite is down to 50.3 versus 57, which is a 19-month low. Softer demand, worse supply disruptions, labor shortages. Again, all of these things that we've been talking about and alluding to are continuing to come in. Supply chain delays continue to prove a persistent drag on the pace of economic growth, linked to port congestion that we talked about, but they are starting to see some adjustment, which we're going to talk about a bit more in a second. But it's still there. It's still tough. It's gotten a little bit better, but it is starting to, it will continue to be an overhang throughout 2022. So looking at the Markit Manufacturing PMI, to put it into perspective, we're right back to where we were in the middle of 2020. We continue to see some of this pressure coming back to about 53. And then when you look at the service side, this will bounce a bit. This is a bit of Omicron and COVID in it. So we will get a bit of a bounce in the service side as manufacturing remains a broader overhang. PMI employment actually went into contraction on the manufacturing front, which is a bit concerning, but not surprising given, you have the holidays coming in, you have a slow start to the year, trying to rebuild some of your inventory, some of the slowdowns that we saw on the consumer side that rolled out in November, December, and we think is going to be in January again, is becoming that problem. But then when you look at prices charged on the service front, you can see that prices charged still remain elevated and at an all-time high. And on the service side, we expect this to come back, but still remain elevated, similar to what we're seeing on input prices in U.S. manufacturing, pulled back a bit to 80. And then when you look at output prices, pulled back a touch. But I think for the next few weeks, I should say next few months, we expect this to really go sideways and bounce around. So Richmond Manufacturing current, you can see dropped. In Richmond now, January came in at 8 versus 14. When you look at the employment component, has rolled over significantly despite a remaining in expansionary territory. We're getting a fairly sizable drop. A number of employees, here's where it's still expanding, but you're coming back. Wages expectations also rolling over a bit, which is a concern when you look at where inflation is and how that's going to impact essentially what is happening, what are going to be the pressure points, and how are you going to be able to afford the rising living cost. Then when we look at prices paid, you can see that on the manufacturing side, prices paid are back to an all-time high. Prices received dipped a bit, but you get an idea that it's not everywhere. There are some places where prices continue to go up and they continue to try to recover those prices. Philly Fed, on the other hand, surprise to the upside. January came in at 23.2 versus the estimate of 19. Prices paid were up, but prices received ticked down. New orders and shipments rose, while inventories and the average work week fell. Employment ticked down, but also expanded. So you're getting an idea that there is some of this kind of balancing act that we're seeing on a lot of these fronts. And then when you look at the Chicago actually came in negative 0.15 versus the estimate of 0.44. So when you're looking at some of the negative contributors, 38 of 85 individual indicators made positive contributions. So you're actually seeing, again, that broader slowdown that we've been talking about. Philly Fed Manufacturing average work week is kind of shifting out as delivery times get a little bit better. That should kind of insulate where some of this is as deliveries come in, being able to do a bit more activity and where this is going to shake out in the near term. So Philly Fed Manufacturer prices paid. This is what I expect others to do. I should essentially just kind of go sideways and just bounce around where on the Fed manufacturing side. And then expected prices paid expectations broke to new highs. So again, you're still seeing a lot of that pricing pressure remain. Now, when we look at Philly Fed, higher than expected, but the more forward-looking parts still indicate a sub-50 ISM later in 2022. And more of my leading indicators that I'm trying to describe to you right now continue to flash the same warnings, just as the Fed is going into QE, quantitative tightening, and raising rates. Now, when we start shifting over, when you look at the real personal wealth, on the wealth side, you can see that there is a growing amount of pressure. And that is something that we want to talk about more in the next segment and where things are going on the U.S. on the income side as well as the real estate side.